Good afternoon and welcome to today's presentation, the Fiscal Cliff, Crisis Averted. I'm Eric Daly. I will be moderating and doing some presenting later on. I want to introduce my co-presenter today, Gina Gurgiolo. Gina is a senior consultant and heads up technical services for the Multnomah Group, and we'll jump into today's presentation. As you have questions, feel free to submit those via the WebEx app. We'll try and address as many of those as we can throughout the presentation, and to the extent that there are issues that require more detailed response, I'll be more than happy to get back to you with those more detailed responses. So with that, I'll throw it over to Gina Gurgiolo.
Thanks, Eric, and thanks to everyone for joining the presentation today. We appreciate you taking the time to join our webinars. First, I wanted to start today's conversation with a look at the fiscal cliff. What is the fiscal cliff and what did it mean to us at the end of 2012 in order to solve it in 2012? What was the real ramification of the fiscal cliff and why did we care? That's the starting point. And then we're going to move into the American Taxpayer Relief Act of 2012. That was really the solution legislation that was proposed and voted on by the Senate really late in the early morning of January 1st, 2012, and then was later on in the same day voted on by the House of Representatives around 11 Eastern Time. There were a few provisions that were added at a last-minute basis. One of those provisions was the in-plan Roth conversions. We'll talk about that most primarily. We'll also look at some provisions that almost were in the American Taxpayer Relief Act of 2012 and what those would have been like if they would have made a legislation that was enacted. And then ultimately, we're going to look at what are the participant impacts with regard to this new piece of legislation and how the in-plan Roth conversion piece might impact them. Then Eric will take over and look at what's next for the markets. In particular, he's going to be looking at the debates around tax, spending, and debt ceiling issues, as well as some fiscal policy with a finale of looking at the direct market impacts of kind of what's on the horizon headwind-wise in the United States. And of course, we'll finish up with some questions and answers. So in terms of the fiscal cliff, what is it? This term was really a term that was first used in 2010 when there were some conversations around extending certain tax cuts. And it was really popularized in February of 2012 by Ben Bernanke, who's the Fed chairman. And what it refers to is a steep decline in a deficit that we anticipated if some of the George W. Bush-era tax cuts were allowed to expire on December 31st, 2012, as they were expected to. The fiscal cliff, if indeed it was something that we saw as materializing, I would have estimated to raise taxes in 2013 by a staggering $494 billion. This, coupled with the mandatory spending cuts of $1.2 trillion that were to go into effect on January 3rd, 2013, were of extreme concern to us on an economic perspective domestically, and it led our Congressional Budget Office and really some other Federal Reserve officials to opine that if we would have, in the United States, fallen off of the fiscal cliff and allowed this steep decline in the deficit to occur, we would have had a recession, certainly perhaps a moderate recession, but a recession nonetheless, and that the unemployment rate would have reached 9% in late 2013. Now that we know really what was the fiscal cliff and what was the problem that we were trying to solve, let's look specifically at the American Taxpayer Relief Act of 2012, that solution legislation, which is also sometimes known as the Fiscal Cliff Act. The American Taxpayer Relief Act passed on January 1, 2013, as I mentioned, in the twilight of the 112th Congress. Interestingly, the 112th Congress was actually set to expire on January 3rd, noon. And so it really was the twilight of the 112th Congress. And of course, as we know, if a bill is proposed but not acted upon in Congress during the term of the Congress, then it expires. And so definitely needed to take care of the issue by January 3rd, 2012, January 3rd, 2013 at noon. That was the real deadline. So the Senate introduced the American Taxpayer Relief Act, voted on it 89-9, it passed. There was some concern that the House of Representatives would not be immediately warm to the proposed legislation that passed the Senate. And in fact, it did take the House of Representatives several hours to reach a vote of 257 to 167 and ultimately pass the American Taxpayer Relief Act. The President signed it and enacted it officially on January 2nd, 2013. In general, the American Taxpayer Relief Act resulted in a less severe decrease in the 2013 deficit relative to 2012, as what would happen as projected under the sharp decline with regard to the fiscal cliff. The American Taxpayer Relief Act delayed the sequestration issue, which is those automatic spending cuts, ultimately inclusive of $1.2 trillion for a period of a couple of months. And we also have an article on the American Taxpayer Relief Act in more general terms available on our website. I've linked it here. Everyone will receive a copy of today's presentation as a follow-up, so you'll be able to link to that article and read some of the provisions of the American Taxpayer Relief Act that did not directly have implications to retirement plans, but rather maybe from a business perspective or from an individual perspective. We know that our clients have some curiosities there, so we wanted to prepare a nice, easy summary of those provisions for you. You can find it on our website. There, link. This piece to look at specifically is, okay, what are the implications to retirement plans, particularly? In particular to retirement plans, it's important to note that there were many provisions and many versions of the American Taxpayer Relief Act that were not enacted. The American Taxpayer Relief Act actually originated in bill form on July 24th, 2012, if you can believe it. And there was vigorous debate and numerous revised versions. With regard to retirement plans, the prior versions of the American Taxpayer Relief Act included a substantially modified salary deferral limit structure that would have decreased the amount of contributions that participants in retirement plans were able to make very substantially, by about 64% was the estimate. And ultimately what that would have done is reducing deferrals, would have increased immediately taxable income, and perhaps revenue base for tax revenue become higher by doing that. There was strong opposition to this particular provision, and it resulted in a lot of debate within the industry, and ultimately it came out of the version that was enacted. So it was a good miss, but nonetheless one worthy of mentioning. Also, the final version of the American Taxpayer Relief Act did not impose that 3.8% passive income surtax on retirement plan distribution. And this passive income surtax applies to people who have investment income and have an adjusted gross income of $200,000 if sold, $250,000 if married filing jointly. 3.8% tax will be levied on certain investment income. We know as a result of the American Taxpayer Relief Act that 3.8% surtax is not going to apply to retirement plan distribution. So those are a couple of almost provisions, but thankfully they were not enacted in the final version of the law. I'm going to spend some time today to detail in-plan Roth conversions with some level of specificity. And this is because this is the most focused impact on retirement plans that American Taxpayer Relief Act had. This was a last-minute decision to add the in-plan Roth conversion provision to the American Taxpayer Relief Act. In fact, it wasn't added until New Year's Eve around 10 o'clock p.m. Pacific Eastern Standard Time. And what it was intended to do was capture additional short-term tax revenue. And the way that would work is that participants who would be making these conversions of non-Roth source dollars under their retirement plan would have to obviously pay immediate income tax liability on the amounts that they're converting Roth. And so the Congressional Budget Office, Fed officials, legislators, and others thought that this might be a good way to increase short-term tax revenue. In fact, they estimated the short-term tax revenue to be $12.1 billion over the course of the next 10-year period of time. I'll go back and provide a little context around Roth deferrals in general and having a Roth source within your retirement plans. 401k, 403b, and governmental 457b plans all may allow participants to defer on a Roth basis. Roth contributions to a retirement plan are after-tax deferrals that are made by participants and separately record kept by the employer and the employer's record keeper as Roth source contributions. The major benefit to Roth contributions is that while the contributions themselves are after tax, the tax-free earnings at distribution create a real attractor to a Roth source being allowed in a retirement plan. And so lots of plan sponsors have adopted a Roth source within their plan. Plan sponsors that have adopted a Roth source have needed to amend their plan document, and these Roth contributions have been available since the Economic Growth, Taxpayer Relief and Reconciliation Act of 2001 and the Pension Protection Act of 2006, which were major forms of legislation that impacted retirement plans significantly and have been doing so for the last 10 years. The issue on Roth that made Roth a little less popular until the Pension Protection Act of 2006 was that the provisions that created the ability for an employer to have a Roth source in a retirement plan under EGTRA of 2001 were set to expire in a 5-year period of time unless they were determined to be continued. And PPA 2006, the Pension Protection Act, actually continued those provisions under EGTRA to make the Roth source contributions a more permanently available feature in retirement plans. So at that point, the adoption rate increased dramatically, and there are estimates that between 30 and 40% of 401k plans in particular have elected a Roth source deferral allowance within the retirement plan. The 403b plan world has adopted less frequently a Roth source, but nonetheless about 20% of 403b retirement plans at this stage have adopted a Roth source, and around 15 to 20% of governmental employers have adopted a Roth source inside their 457 plans. In-plan Roth conversions have been available since 2010. The IRS put out a notice 2010-84 in particular, that allowed a conversion of non-Roth money in a retirement plan account by participants who had an employer who was allowing Roth source within the plan. Those participants with those plan documents that allowed Roth sources were able to convert, starting in 2010, non-Roth source deferrals to make them Roth source deferrals. The trick is that you have to pay the tax on the amount that you are seeking to convert to Roth status. So prior to the American Taxpayer Relief Act, these in-plan Roth conversions, though, required that the participant who wanted to execute an in-plan Roth conversion actually experienced an event that allowed them to be eligible to take a distribution under their retirement plan. And this was essentially practically meant that participants who weren't eligible to take a distribution, who, i.e., were not age 59 and a half, or who had not separated from service or who aren't able to take a distribution that was eligible for rollover could not make these in-plan Roth conversions. In talking with some vendors who provide record-keeping services across the country, I talked with the second largest record keeper in terms of the number of participants that they utilize, that they have on their platform, and only 9, about 50 million participants with this particular vendor, have actually converted Roth dollars, non-Roth dollars to a Roth source. Only 9 out of about 50 million participants have done this at this one major record keeper. So you can tell that the uptake has been quite low. In fact, plan sponsors who have adopted a Roth provision haven't full bore across the board adopted the ability to make in-plan Roth conversions within those plans. And so what the American Taxpayer Relief Act did was it liberalized the rules. It recognizes that the utilization of in-plan Roth conversions have been very low since 2010 when they were first able to be done, and the folks who were working on the American Taxpayer Relief Act thought, well, maybe if we liberalize the distribution rules, people will use the Roth conversions more frequently. So what the American Taxpayer Relief Act did was it eliminated the requirement to take a distribution, to be able to take a distribution from the retirement plan in order to have the in-plan Roth conversions. So now, any participant on a plan that allows in-plan Roth conversions can take non-Roth source contributions and convert them to Roth contributions and have those monies separately record kept in a way that will allow for no tax liability on the earnings at distribution. In addition, the American Taxpayer Relief Act stated specifically that 3.8% surtax on investment income for certain highly compensated or high wage earners, that 3.8% surtax is not going to apply on the amounts that are converted. In-plan Roth conversions are irrevocable, as are decisions to defer dollars on a Roth basis to a retirement plan. And what this means is that today it might look very attractive for a participant to have Roth dollars going into the plan or to make an in-plan Roth conversion, but nobody really knows what the tax rates are going to be in the future. So because in-plan Roth conversions are irrevocable, that could be another reason why participants have not en masse utilized the potential significant tax benefit associated with in-plan Roth conversions. Participants, though, may use in-plan Roth conversions to avoid the uncertainty of future tax increases. So it's potential that tax rates in the future will go up, and so participants are essentially locking in tax-free status of those distributions now rather than being subject to those particularly higher tax rates in the future. So participants who expect to be in higher future tax brackets may convert to pay tax on their current lower income tax bracket rate, these dollars from non-Roth to Roth status. Roth conversions in the plan are available to surviving spouse beneficiaries and spousal alternate payees, but not a spouse, and you are a beneficiary under a plan that does allow in-plan Roth conversions, or you're an alternate payee that is a non-spouse, you do not have the capability to do an in-plan Roth conversion under the law. While in-plan Roth conversions are allowed legally today, I mentioned that the Notice 2010-84 is where the IRS described the rules, and now the American Taxpayer Relief Act has liberalized the rules on the distribution requirement. However, what the American Taxpayer Relief Act did not specify includes some details around how exactly in-plan Roth conversions need to be administered on a number of levels. And so what the legislature did was ask the IRS to issue guidance with regard to a couple of gap pieces of information that we don't yet know the answers to. A couple of those are, what is the effect on the distribution procedures in general under the plan? And do we need to make a change to that notice that we send to participants to let them know of their tax liability with regard to distributions made under the plan, as well as rollovers that are made under the plan? How does that notice, what we call 402F notice or special tax notice, need to be revised for in-plan Roth rollovers is a question. Also, another thing that plan sponsors are urged to do is to communicate with their retirement plan record keepers to determine what the record keeper is thinking in terms of their readiness to administer on the record keeper level these types of provisions in a retirement plan. Make sure that they have the right capabilities to ensure the right processes at the record keeper level, and also the employer at the employer level must determine that they have the appropriate processes in place to ensure that these types of contributions are handled appropriately. So are waiting further guidance clarifying from the IRS how exactly in-plan Roth rollovers will work after the American Taxpayer Relief Act has gone into effect. And our recommendation from the Multnomah Group would be, number one, check in with your retirement plan vendor, make sure they have the capabilities. Number two, determine at the plan level whether or not you do or don't want to adopt this type of provision. If you don't have a Roth deferral source provision already in your retirement plan, and you want to allow for these in-plan Roth conversions, you first have to adopt the Roth source, and then also after that adopt the in-plan Roth conversion piece. Another thing that's important to promote utilization of the in-plan Roth rollovers, we need to communicate effectively with participants. So what is a new option for employers, and it might seem very attractive immediately to lots of employers who currently allow Roth contributions in the plan. We urge you to take a few necessary steps before you determine that you will be actually adopting such a provision. An important thing to note is, really what is the impact to participants stand to be? First question is, will plan sponsors and participants take advantage of the in-plan Roth conversion provisions that have been liberalized under the American Taxpayer Relief Act? I mentioned that, the second largest record keeper in terms of number of participants has seen 9 of these in-plan Roth rollovers, and so we know that there's been a significant amount of pre-American Taxpayer Relief Act underutilization of in-plan Roth rollovers. So is the American Taxpayer Relief Act's liberalization of the distribution rule enough to cause a shift in utilization of these types of provisions? The next question is, can participants afford the tax bill? Rather flippantly, the IRS suggests that participants can plan for the increase in their tax bill by increasing the withholding for tax liability in terms of their number of withholding allowances. It probably sounds a lot easier than it is to a participant in practice. So whether participants can afford the immediate tax bill that will be a liability if they do an in-plan Roth conversion is going to be a significant question. Then the next question to consider is whether participant tax burdens will affect how they participate in the retirement plan. The American Taxpayer Relief Act, on an individual participant basis, has some provisions with regard to just an individual's tax liability as an income earner, generally speaking. And so the question becomes, if somebody's tax bracket has changed, does that affect how they participate in the retirement plan? Some education campaigns around the 2009 timeframe encouraged a 2% deferral increase when the payroll tax rate was cut by 2%. So the question is, will participants decrease their deferrals now by 2% since the payroll tax rate increased back up to 6.2% with the American Taxpayer Relief Act? Retirement plan distributions, as I mentioned, we know are not subject to that 3.8% tax on investment income for certain high-income earners. And this gives the industry, I think, a sigh of relief, because having participants have an additional 3.8% haircut to take on their retirement plan distributions is kind of the opposite of what we need. We need more participant accumulations in retirement plans to solve the retirement readiness crisis that we might have brewing in the United States. So it was very welcome to know that that 3.8% surtax is not going to apply, and that participants can keep that money in their accounts to continue to earn and hopefully gain and provide a nice secure income into their retirement. That said, now we're going to take a look at what's next for the markets.
Thanks, Gina. So the American Taxpayer Relief Act clearly assisted us in getting some certainty on marginal tax rates. So we saw an increase in marginal tax rate. It's at the very high end of the earned income spectrum. Also saw an expiration of the payroll tax holiday, which I'm sure has hit a number of participants in their direct take-home pay for the start of 2013. That certainty helps the consumer side. The great question for plan sponsors then becomes, will the remaining items of the fiscal cliff, which were not resolved and instead were pushed into 2013, impact equity and fixed income, national equity market performance? How will that affect my participants, my plan, in ways that are broader than, again, just the take-home payroll issues? So ATRA provided some temporary relief to the spending sequestrations that Gina mentioned earlier, but because the spending issue was not resolved as part of the American Taxpayer Relief Act, really the extension of the sequestration was intended to provide an opportunity for Congress and the executive to strike a grand bargain on spending and revenue increases. They have proposed having that occur by the time March comes around. There's now been a bill passed that extend the sequestration into May, and it's very likely that we'll see the Senate and President sign a bill that would push the sequestration extension to May. The concept here being that if we can delay the actual enactment of the sequestration, that would provide ample opportunity for an adequate debate and hopefully a grand bargain on spending. So if we are ultimately going to bring the spending side, the deficits that we're currently accruing, into balance, it'll be necessary to adjust spending. To do so with sequestration, which is a hatchet method, unfortunately has some pretty significant consequences on the spending side, which would take an already hobbled economy from a growth perspective and make it that much more challenging to generate meaningful GDP growth prospectively. Unfortunately, the early stages of the spending debate don't lead many to anticipate a true grand bargain on the spending side. So you take the fiscal cliff and kind of chop it into smaller bites, the likelihood of getting a truly comprehensive outcome that reviews both the revenue side, taxation, as well as the spending side becomes less and less likely. Debt ceiling debate part 2 ultimately is going to come likely, as have all the other tax revenue bills, down to the May 18th debate on spending and sequestration. Really good a grand bargain. Clearly that provides us a more certain environment for businesses to grow and ultimately should have a positive impact on markets. In the interim period between now and May 18th, what we're more likely to see is periods of high volatility related to what the market anticipates the likelihood of any regulatory change to be on markets and market performance. A component of the grand debate structure and the May 18th extension ultimately has to do with where should the budget come into balance. Ultimately, we've increased revenues by the expiration of the tax holiday and the increase in marginal tax rates at the high end of the income spectrum. However, as we start talking about the spending side, the executive branch has made it relatively clear in the early stages of the debate they have very little intention to see massive changes on the spending side that are paired with equally significant changes on the revenue side. So ultimately, we get to a point where we're going to have to wrestle the revenue equation again. So the first round of tax increases and revenue increases for 2013 is likely to be the only revenue increase that we see over the course of the year. However, trying to arrive on where the balance between spending and revenue increases should come out is going to be very, very challenging. And at the same time, we have the debt ceiling, which becomes yet another challenge and hurdle by which we need to get some form of congressional action to allow the U.S. government, obviously, to increase this debt ceiling and continue to make good on the already committed obligations and treasuries that have been issued. Narrow amounts of time, when you begin to bring the revenue side into the equation on spending cuts, it makes it very, very difficult to get a truly comprehensive and well thought out revenue package. We look ultimately at where we see likely changes to tax rates. It's not likely to be grand changes in what the marginal rates are. And because politicians don't like to change marginal rates, it's certainly not very popular. What they could do is change deduction structures. Although it has exactly the same impact, is much more easily swallowed by U.S. taxpayers. So the debate has centered around things like, should there be a hard cap on the dollar value of deductions that any taxpayer may take? So is it to get deductions on the first $40,000 and everything else above that no longer is deductible? Certainly that is one type of structure. That one seems less likely. Ultimately, the alternative minimum tax was intended to provide essentially that same type of control, which is regardless of how much you make, you need to pay at least this much in taxes. A hard dollar cap would take the already challenging AMT rules and make them that much more challenging. I think there likely is a hard cap on the deduction rate. So if I'm a high income earner and my marginal tax rate is 35+%, if I make a $100,000 donation, only I get to deduct my marginal tax rate, 35% in this example of that particular contribution. If cap the amount is deductible, or the deductibility rate on those contributions, I think you have what is more likely a palatable solution, where politicians can say it's no longer fair for XYZ individual to get a 40-cent or 35-cent break on their contribution when you only get a 28-cent tax break on that same contribution. So I think from a sellability perspective, it seems to be pretty consistent with some of the debate we heard around marginal tax rates going to the end of 2012. There's some discussion about exempting specific deductions, mortgage interest, or in this example, interest deductions for tax-exempt municipal bonds. I think that would be very, very difficult to do. In the case of the mortgage interest rate, we've had the strongest area of the economy, arguably, and what's driven some of our growth has been the performance, ultimately, the residential real estate market. And if you dramatically change, and in this case, eliminate entirely mortgage interest rate deductions, that will have an impact on housing prices, without question. It would be crippling to the economy. On the municipal bond side, while the changing in tax policy would have argued a tremendous amount of impact on the individuals who traditionally buy municipal bonds, the reality is with cities, counties, water districts already strapped for cash and laying off employees at an ever-increasing rate, if you tend to take the one advantage that they have in the debt market, which tends to be the double tax deductibility, the interest that's being paid on those bonds, it makes it very, very difficult for them to fund operations. So it seems that would be two very unlikely ways to change the revenue equation. On the spending debate structure, if it is a grand bargain, it lies somewhere within the framework of Simpson-Bowles, which obviously was bipartisan in nature. It had some grand areas of agreement on what is ultimately a hugely important portion of the debate, which is Social Security, Medicare, those types of expenses that will run, obviously, for decades and millennia to come. Administration provides some opportunity to at least arrive at a grand bargain as it relates to spending. Ultimately, the challenge with sequestration and even the challenge in adjusting spending for discretionary items today, take, for example, sequestrations to defense and non-defense discretionary. The problem is that any spending cuts that come out of those areas take out of the economy today. So ultimately, if we say we're going to reduce any of our non-defense discretionary spending by $93 billion, as was proposed under the sequestration for 2013 alone, that has an immediate impact of over 0.5% of GDP today. And we're not growing at such a rapid rate. We're taking 0.5% off GDP. It's particularly palatable. The alternative would appear to be to adjust things that have a increasing value and impact on the spending side, but actually pull dollars out of the economy prospectively. So the two big examples continue to be Social Security and Medicare. One of the ones that seems to make sense, for instance, is utilizing a chained consumer price index methodology for Social Security rather than the current simple CPI methodology. CPI just acknowledges what is a truism for any individual that has to maintain a budget, which if steak goes to $42 a pound, I buy less steak and I replace it with chicken. So you have to acknowledge that there are some transitions and replacements that take place anytime there's a massive escalation on the spending side. So do something like utilizing or adopting a chained CPI methodology for Social Security prospectively. Doesn't take any money out of the economy today, doesn't affect any Social Security checks in 2013, and it has marginal impacts over the subsequent years. But adopting that now has a magnifying impact over the 20, 30, 40 years. Clearly, the other area where there has to be some type of bargain struck has to do with the age at which individuals are eligible for care under Social Security and Medicare. So looking at where we are from an eligibility perspective and potentially drawing it out for younger workers now, which does violate any of the promises that we've made to older workers, but again has a significantly magnifying impact on spending prospectively. Policy continues to be a huge debate, and arguably has been one of the things that's impacted market performance most dramatically. There's been much discussion about the likelihood of Bernanke retiring at the close of 2013. The reality is that whether Bernanke stays or goes likely has almost no impact on Fed policy. Almost everyone thinks that Janet Yellen, who's currently Vice Chair of the Federal Reserve, would step into Bernanke's shoes. They have been lockstep on policies related to liquidity and adding money to the economy. As a result, monetary policy and QE3 or QE infinity likely to change in the near term. The stated objective is to maintain a low interest rate environment until unemployment in the U.S. gets under 6.5, and we are a long ways from under 6.5. So as long as you believe that the Fed can continue to make good on us to maintain this low interest rate environment, which they have been very, very effective in doing over the course of the last couple of years, we would expect on the fixed income side an environment that is not undifferent to the one that we've experienced most recently. Quantitative easing, we've seen tremendous Treasury purchasing. We have seen an uptick in the 10-year Treasury rate, most recently just slightly north of 2, but 2% on a 10-year Treasury. You're looking at an environment where Treasuries as risk-free alternatives, probably a negative real return when we take into account likely inflation over that period of time. They've all been very, very heavily invested in the mortgage-backed security markets. As a result, obviously the mortgage market continues to be, for those who qualify, an area where interest rates are very, very low. In conjunction with the discussion on where Treasury rates are, that this rate of growth has certainly slowed. As a result, this being tremendous purchasers of Treasuries has certainly backed off. However, when you look at where Treasury purchases are coming from, while the Fed is a significant buyer, a number of other sovereign entities have stepped into China's shoes to repurchase Treasury issues that we've been certainly running at a rapid rate. One of the things that could slow the economy and ultimately have an impact on GDP is if the Fed and other outside buyers choose not to maintain this low interest rate environment, and we do see a rapid escalation on 10-year Treasury rates. Obviously, the cost of carrying those bonds increases as we issue and make new issuances, and that does have an impact on the spending side. That is obviously not a non-discretionary area, but an area of real money nonetheless, where the interest carrying cost could increase, thereby shrinking out other growth opportunities. A tremendous amount of market volatility we would expect through the first half of this year, assuming that the May 18th date holds true. Like the debt ceiling debate before in 2012, if we don't get settlement and there's pessimism going into that, you would expect to see markets impacted negatively until such time as a bargain is struck, and if the bargain is one that's palatable, you could see certainly an uptick on the market side after that. Continue to see a very unlikely to see much inflation from 2013 and even beyond. I mean, there's some that think the Fed will reduce somewhat the quantitative easing program, even though we may not be under the 6.5% unemployment rate. But even if that were to happen aggressively, you would be looking at low inflation through 2013 and into 2014. No return on the risk-free rate, 10-year Treasuries. You continue to have high buying and high holding of Treasuries as an alternative investment. The risk-free rate could continue to be less than the inflation rate, meaning if you want to park it in what, at least from an economic perspective, we call the risk-free rate, you're actually there's a cost to carry your dollars and holding them. There is continue to be pressure on the euro and yen. The pressure on the euro has been so well documented, I hesitate to even mention it. Is challenging as our deficit situation has become here in the U.S. We compare it to a number of European entities, look far, far more favorable. And as a result, as they bring those currencies and fiscal and monetary policy in place in the European Union, you would expect to see continuing pressure on the dollar to euro rate. The interesting new news really is from the Bank of Japan, and the Bank of Japan, who's been in a potentially deflationary environment over the course of the last decade. Bank of Japan has announced their intent to stimulate the economy, which some are reading as a harbinger of actually devaluing the yen to the dollar, making it perhaps easier for them to export goods to the U.S. So the euro and yen under great pressure. Again, the U.S. looks stronger from a monetary policy side as long, again, as the 10-year Treasury rate can continue to be historically low. I think you're going to continue to see heavier allocations in equities, real estate, and commodities, depending on what your expectations about returns are and your needs or desire to try and hedge against inflation. With artificially low interest rates, it becomes very, very difficult for fixed income investors to achieve return certainty in the marketplace. Even in 2012, when you're looking at the Barclays Ag up some negative 4.5%, trying to achieve a 4 and a 4.5% growth rate on the Barclays Ag, given its construct, an interest rate environment as low as this one becomes very, very difficult unless you see another event pushing interest rates lower than they are today. Ultimately, you could see some modifications in investment strategy for tax-sensitive investors. So obviously outside the retirement plan spectrum, you'll see more investors trying to adopt more tax-sensitive investment approaches that have impact on, for instance, equities that pay large dividends. What is their likely demand in the marketplace given changes in tax rates? Those will be relatively quiet as it impacts institutional investors. The reality is that the taxable investment market doesn't drive in any meaningful way historically the performance of subsectors of the market. At the end of the day, we think while there's going to continue to be noise, 2013 begins to look a lot like 2012. Certainly we off the year relatively quickly. There is going to be lots of noise related to the sequestration, certainly related to the increase to the debt ceiling, and there are going to be 200 things that we can't even anticipate as we sit here today. But if the low interest rate environment continues to hold, it does create fewer and fewer alternatives for investors who need to achieve a return that's greater than, in some cases, significantly greater than inflation. So as we look back at 2012, using the Russell 3000 as an index that was up about 16.4, almost without regard to what news was occurring at the time, the news cycles, as pervasive and scary as they can be, don't tend to have a very long-term impact on market returns. Fundamental issues related to growth, profitability, and certainly the degree to which organizations are able to get more and more revenue for each labor unit, which continues to be a pretty significant trend over the last 3 years, drives equity market performance. So we will open it up for some questions. If you want to submit those.